The financial calendar for the week of May 25, 2026, opens under heavy pressure following Monday's Memorial Day holiday. This shortened trading week confesses the release schedule, forcing multiple high-stakes economic indicators to collide over a span of just 4 days. Investors are facing a two-track economy. They have to reconcile massive capital expenditure in enterprise AI against a domestic consumer base that is structurally breaking down. All of this data is landing during a historic leadership transition at the nation's central bank, as Jerome Powell formally exits his post. Following a tight 54-45 Senate confirmation vote on Friday, Kevin Warsh has officially taken the reins of the Federal Reserve. Warsh carries a mandate strictly focused on long-term price stability. He steps into the role exactly as accelerating geopolitical supply shocks hit the domestic market. To correctly price bond trends and equity valuations this week, fixed income desks must map out how Warsh's hawkish framework will react to an economy that is simultaneously inflating and contracting. This minimalist chart shows the current baseline for the federal funds rate, which Warsh inherits holding steady at 3.5% to 3.75%. Against that baseline rate, bond markets are pricing in a completely flat spread between the 2-year and 10-year yield curves. The primary inflation catalyst disrupting those yields originates here: ongoing diplomatic discussions regarding physical safety across West Asia sea corridors. Washington recently confirmed that its naval blockade on Iranian ports remains active until a pact is signed, locking a permanent war premium into WTI crude prices. Looking at this line graph, you can see how those compounding energy shocks have forced economists to drastically raise the Q2 headline PCE projection to 4.5%. That brings us to Thursday's definitive inflation gauge, April core PCE. The critical threshold to watch is a monthly print landing above 0.3%. The maritime blockades have driven domestic fuel prices right back toward the $5 per gallon threshold. Tuesday's Consumer Confidence Index reflects that reality. Sentiment is facing severe downward pressure, indicating structural wallet fatigue right before the peak summer travel season. The true pulse check arrives Thursday with quarterly earnings from Dollar Tree, which will expose the unvarnished spending habits of lower-income households. Retailers are carrying the burden of stretched budgets. We are watching shoppers actively pull back on discretionary goods just to cover basic staples. And despite persistent rumors of targeted relief, the IRS and Congress have repeatedly confirmed that no federal stimulus adjustments exist for 2026. That same combination of high costs and low affordability is currently freezing the physical housing market. This dual-axis chart maps out the problem. Mortgage rates are tracking a resilient 10-year Treasury yield that remains stubbornly locked at 4.40%. Consequently, total housing starts across the country have steadily trended downward, approaching 1.3 million units. Home builders cannot rely on organic demand. They must aggressively deploy financing incentives just to move existing inventory. Thursday's second Q1 GDP estimate from the Bureau of Economic Analysis will aggregate this consumer weakness and housing drop. Analysts are hunting for downward revisions in real private domestic demand. If demand falls while energy prices rise, that is the literal definition of stagflation. The severe strain on the American consumer sits in stark contrast to the massive capital expenditure occurring in the corporate tech sector. This bar visualization captures the sheer scale of the hardware boom, driven by NVIDIA's blockbuster Q1 revenue print of $81.6 billion. But hardware layout requires a return on investment. Portfolio managers need concrete proof that these infrastructure costs are translating into enterprise software revenues. The critical secondary validation test hits midweek, led by earnings reports from Salesforce, Dell, and Snowflake. If these bellwethers show a lag in software adoption, the math is simple. AI operational costs are directly eating into corporate margins. Margin compression at this scale would force a significant valuation check across major tech indices. Beyond tech, we will see broad capital expenditure trends detailed in Thursday's April Durable Goods Report. Manufacturing desks are navigating a brutal dilemma: freeze their capital spending due to elevated borrowing costs, or accelerate their hardware updates now to bypass shifting tariff schedules. The core capital goods data from this report will heavily influence the post-holiday performance of industrial and supply chain stocks. If AI software fails its validation test, tech valuations will face a sharp correction at the exact moment the broader consumer economy buckles. To understand how the Federal Reserve will weigh tech capex against consumer fatigue and geopolitical shocks, we have to look at their internal math. Friday's macro calendar concludes with the Cleveland Fed's multivariate core trend inflation model, a critical data stream for institutional asset managers. This scatterplot demonstrates the model's function. It aggressively filters out raw, extreme data points to isolate the underlying structural inflation trend. It is specifically designed to ignore transient shocks, like temporary global shipping spikes. By stripping away that temporary noise, fixed income desks can calculate a highly accurate inflation floor for the remainder of 2026. The structural threat converges here. If AI software revenues flag, while the core PCE effectively clears 0.3%, then the entire market enters a confirmed stagflationary environment that will aggressively test the valuation of every major equity. Confronted with a high inflation floor and contracting domestic demand, Kevin Warsh has zero room to maneuver. As this timeline projects, the Fed will be forced to hold the 3.5% to 3.75% rate in a strict higher-for-longer reality. That unyielding rate becomes the permanent baseline, locking in elevated costs for a fracturing low-income consumer base and a starved housing market for the rest of the year.